Gold is one of the most macro-driven assets that exists. It doesn't move because of support and resistance. It doesn't move because of whatever order block. It doesn't move because of an RSI divergence. Gold moves for one reason. It reacts to beliefs in interest rates, inflation expectations, central banks, geopolitics. And so today, I'm going to show you how to read and understand these beliefs in advance so you can catch and position before the trends. Now, to get to that, we need to ask a bit of a dangerous question. What is gold? Most people will say it's a hedge, it's a safe haven, it's a store of value. They're all true, but they're also all completely incomplete. Because none of these answer and explain why, for instance, sometimes gold goes down during high inflation. In 2022, as you can see, gold trended lower despite inflation moving higher from 1% to 6%. How is that possible? Well, there's an important piece that everyone misses. See, the most important thing to understand about the precious metal is that gold has no yield. It pays no interest to hold, it pays no dividend, unlike bonds, which pay interest, and unlike stocks, which pay dividends. So it's not an asset that people buy for yield, it's an asset that people buy because they don't like the alternative. They don't like the interest that they see in bonds, they don't like necessarily the potential return that they see in stocks. We're going to get this in a second. First, let me explain. Gold's entire valuation comes from something called an opportunity cost. It's basically, what am I missing by holding gold instead of holding something else? The loss of an alternative when one alternative is chosen. Once you frame it this way, everything starts to click. Let me show you. To understand everything, literally everything, we need to talk about interest rates. If interest rates are rising, what happens? Cash pay more and bonds pay more. Now, ask yourself, why would anyone want to hold an asset that pays zero interest while, for instance, interest rates are high? Well, they wouldn't. This is why, generally speaking, when the Federal Reserve is aggressive and it's hiking interest rates, gold falls. It's simple competition. Think about it. Gold is competing with the dollar and the bond market for attention and for capital. And when the dollar and the bond market pay 5% interest, whatever, then the dollar and the bond market win against gold. And this is why we see gold falling when interest rates rise. Think about it. If you buy the precious metal, it sits there, it pays you zero interest. Now sure, it pays you the potential return, but we're talking about asset managers that are looking for carry, they're looking for interest. If you buy the bonds, and let's say the Federal Reserve has, for instance, 5% interest rate, then the government pays you 5% interest rate a year for just holding the bond. So what do fund managers do? They flock into that 5%. They go to the bond market. That's the opportunity cost in simple. But, and there's a massive but, rates are only half of the story. And this is where I see everyone getting trapped. See, interest rates can be 10%, 15%, and gold can still explode higher. This is what happened in the 70s. We're looking at the Fed fund rate in orange and gold in candlestick. You can see interest rates up and gold up with it. Why that happened? Because nominal yields, so the regular US 10-year yields that you see on TradingView, does not matter as much as something else does. And that something else is the real yields. Now, if you don't understand this distinction, you miss the whole point. So hold tight, because it's very simple. Listen closely, and I mean seriously, listen closely, because if you take nothing else from what I said in this video, if you're just waking up after 6 minutes of me rambling about the opportunity cost, just listen to this part. This is the institutional edge. Real yields equal regular yields, but minus inflation expectations. For the economists out there that want the technical definition, real yield is the nominal interest rate adjusted for the erosion of purchasing power due to inflation. Now, you can find real yield in TradingView, but here's a little secret. You have to dig deep. If you go onto the search bar and you look for real yields, and you type that out, you're not going to find anything. We have to construct the real yield because there's no readily available asset for it. We have to build a formula for it. So let me explain. The US 10-year yield that you see here, it's the nominal yield, the regular 10-year yield. This hard asset is the 10-year break-even inflation rate. It's basically inflation expectation, 10-year inflation expectation, so medium-term inflation expectations. What we're doing here is taking the 10-year yield minus what? Minus inflation expectations. What are year yields? Are nominal yields minus inflation expectations. So this formula here builds the real yield on TradingView, and this is the one. Now, when you look at this, you're gonna see that it doesn't really have much difference with the nominal yields in movements, but there are certain periods where they do move differently. And so it's important that you understand the distinction between the real yield and the nominal yields. So just write this on TradingView and save it into a watch list. Name it real yield, and you're gonna have it. Now, here's why all of this matters, okay? If you can earn 5% return on a bond, but inflation is running 8%, you're not earning 5%, you're losing 4%. Why? Because you're losing purchasing power. So suddenly, holding cash, holding bonds is not attractive anymore. And so gold starts to look like an honest asset in comparison. What I just said here is pretty much everything. So let me get deep into it. Gold does not compete with stocks. It does not compete with crypto. It competes with yield adjusted for inflation. When real yields rise, holding cash and bonds becomes more attractive. So what happens? Gold falls. When real yields fall, gold becomes the attractive alternative, to holding treasuries or holding the dollar. So what happens? Gold rises. This is pure math. If inflation expectations rise faster than nominal rates, real rates drop and gold rises. This relationship right here is the core of what I'm about to explain you now. Because to understand gold, as you've seen, we need to understand real yields. So now you're gonna ask, well, okay, how do we actually analyze real yields? How do we understand where real interest rates are actually going? To understand where gold is going. Well, this is where the Federal Reserve comes into play. Markets are constantly asking one question. Is the Federal Reserve tighter or looser than we thought yesterday? A hawkish Fed, so a Federal Reserve that is looking to raise rates, keep them high, leads to higher real yields, which, as I've explained you, it's bearish for gold. A dovish Federal Reserve, so a Federal Reserve that is looking to cut rates or keep them low, leads to lower real yields, which, as I've explained you, boosts gold. Now, this is why the statement that you've seen many times, I'm sure you've seen it, where they say inflation is high, so gold should go up. That statement is phenomenally wrong. It's actually dangerously wrong. And I see a lot of traders falling into that. And you'll see actually a lot of traders saying that on social media, whatever. Gold is the inflation hedge. They say inflation is up, so buy gold. That is wrong. See, inflation alone means nothing. What matters is the response to inflation. Inflation matters in relation to what yields are doing. So again, real yields. In other words, and listen closely here, what matters is how credible the response to inflation is. If inflation is high and the Fed is aggressively tightening, then real yields rise and gold struggles. Just watch what happened in 2022. Inflation rocketed, money interest rates also rocketed with it, and Powell was pretty much very determined to raise rates as high as necessary to lower inflation.
We're going to hear from the chairman of the Federal Reserve. Let's listen in.
Today, my remarks will be short, my focus narrower, and my message more direct. The Federal Open Market Committee's overarching focus right now is to bring inflation back down to our 2% goal. Restoring price stability will take some time and requires using our tools forcefully to bring demand and supply into better balance. Reducing inflation is likely to require a sustained period of below-trend growth.
Now, Powell was very credible here. Rates were rising aggressively, and the Fed was committed. So gold, despite the extremely high inflation, it fell. Why? Because real yields went up. This is so important to understand. I cannot stress this enough. It's not just about inflation. It's not just about yields. It's about real yields. So yields on net with inflation. In fact, the opposite is also true. In 2025, inflation wasn't as high as 2022, absolutely not. But still, it was above target, around 3% or so. But, and this is the point that I want you to absolutely understand, the labor market was weakening and the Fed could not stay aggressive. Rates came down despite inflation still being at 3%. So what happened to real yields? They fell. And what happened to gold? It absolutely rocketed. In other words, in this example, if inflation is high and the Fed is behind the curve, maybe it's boxed in politically like it's happening right now, or they cannot raise rates because the labor market is weakening, which by the way, it's called stagflation. So weak growth and high inflation, which means real yields fall and gold rises. The point is, what I'm showing you here is that gold is not an inflation hedge. Gold is an hedge against a loss of confidence in policy. It's when people think the Federal Reserve will not protect them against inflation that they start rushing away from the dollar into gold as an hedge. They dump the dollar because they are afraid it's going to lose purchasing powers, and they rush into gold. That's a very different thing, okay? It's the difference between what happened in 2022 when inflation was 8% but gold was dropping because the Federal Reserve was extremely committed, to hike rates as much as possible, as hawkish as it gets, to instead 2025, where inflation was 3%, not as high as 2022, but still relatively high, but the Fed was worried about a weakening labor market, which was forcing them to cut rates despite the high inflation. Understood so far? Perfect. If you haven't, you can rewatch the first part of this video as many times as you want. You can just go back and rewatch it until you understand the point. If you understood it, we can move to the next part, because now we have to talk about geopolitics, war, sanctions, trade tensions. These things add a premium to gold. This is where it earns its safe haven badge, because when uncertainty spikes, capital, they stop caring about yield, they stop caring about interest, they stop caring about return essentially, they just want safety. Think back to February 2022. You check the news and tanks are crossing the border into Ukraine. Obviously, what happened to gold? It rocketed higher. This shouldn't be too complex to understand, obviously. And obviously, didn't just rocket higher after the news. It went up into the news because it was getting pretty obvious. And this is the point that you always have to understand. Markets move on expectations. So gold obviously acting as a safe haven. It moved before the news and then it expanded further higher once, the thing actually was confirmed. This should not be too complex to understand, obviously. Geopolitical escalations are simply bullish gold. But the important bit to add here is this. Geopolitical flows often, not always, but very often, are a very short-term type of flow. Geopolitics can create momentum short-term, but if real yields are rising, geopolitical tensions alone will not keep gold elevated for long. If you look again at 2022, you can see what happened. Obviously, geopolitics with Russia, gold spiked. But yet, after this move, it failed to continue higher. Why? Why so? The geopolitical tensions went on for months. Sanctions, tariffs, everything went on for months since the invasion happened. But yet, gold fell. How so? Because of real yields. The Fed started to hike rates 50 basis points, 70 basis points at a time after that, because obviously oil was spiking higher, energy costs were rising, and so inflation was rising as a result of that. So the Fed was committed to keep inflation as low as possible, to stop inflation from rising, and to do that, they needed real yields to move higher, to tighten monetary policy. So real yields moved higher and gold moved lower despite the geopolitical tensions. So treat geopolitics as a short-term accelerant, but not the foundation, because the foundation are real yields. Now, when we talk about geopolitics, I have to address the biggest misunderstanding of the relation between gold and the US dollar. See, textbook articles and videos out there tell you that they are inversely correlated. And that's all. They stop right there. They tell you if the dollar goes down, gold goes up, and they stop right there. Well, yes, gold is priced in dollars. So mathematically, if the dollar gets stronger, gold drops. But, dollar up, gold down, gold up is the rule until it isn't. When the market is ruled by geopolitical flows, gold and the dollar can go up together at the same time. Why? Because they are two safe havens. The dollar is a safe haven and gold is a safe haven. What you're looking at here is gold overlaid with the dollar index in 2019. Gold is in candlesticks and the dollar index is the orange line. Now, if you don't know, this was a year dominated by geopolitical headlines between China and the US. This was the trade war, which was at the center of the attention, and so safe havens flows dominated this entire year. De-escalation between China and the US led to what? Lower gold and lower dollar, both safe haven, while escalation between the two led to higher gold and higher safe havens, so both gold and the dollar. Likewise, in February and March 2022, with the geopolitical tensions with Russia, you can see both gold and the US dollar moving higher together on safe haven inflows. So do not make the mistake of reducing gold to a dollar index inverse asset, because it's not true. They can be actually inversely correlated, obviously, but they can also be correlated if the dominant narrative is a geopolitical one. Okay, I've dumped a lot of macro information on you, so let's structure this into a framework now. How do professionals actually put this together? Well, they look at real yields, so understanding both interest rates and inflation. They understand what the Federal Reserve is doing, so they understand the forward guidance. Are they hawkish? Are they dovish? They have an understanding of the geopolitical context. Is there a geopolitical headline heating up? A geopolitical situation, starting to heat up? And with all that, they understand what gold should do. If the Fed is dovish and real yields are dropping, the dollar is looking weak because of that, and geopolitics may be at confluence, maybe they're quiet, doesn't really matter, then what do? You look for longs on gold. So you look at the chart and you start looking for the technical trigger and you position. On the contrary, if the Federal Reserve is hawkish and so real yields are up, and there's no particular geopolitical tensions, maybe, let's say, geopolitical things are de-escalating. Maybe there was a conflict, maybe there were some tensions, and now they're settling down. So real yields up, geopolitics down. What do? You short gold, okay? This is fundamental analysis for gold. Narratives backed up by data. So when you look at gold, you should ask yourself, what are real yields doing? What is the Fed doing? What's the reaction function? Are they more worried about the labor market? Are they dovish? Are they hawkish? Are they worried about inflation? What's going on with the Federal Reserve? What's going on with central banks across the globe, across the world? And on top of that, is geopolitics adding a premium to it, or is it fading? If multiple answers on this point in the same direction, then you go to the chart, you have your bias, and you look for the entries in the fundamental direction. Fundamentals give you the bias, technicals give you the timing. Now, if this video made gold feel a little bit less random and a little bit more readable, hit the like button and lets YouTube know this video is valuable. And subscribe, obviously, if you want more fundamental analysis explained like a human being and not a boring academic textbook.